Welcome to Chapter 1 in Accounting, and I will be breaking this chapter up into hopefully not too long of videos, but there will be multiple videos. Otherwise, this would be a monster long video and you would all get sick of listening to me. We're going to just dive into learning objective number 1, which is basically what is accounting and who uses it. Accounting, as your slide says, is a way of measuring information that identifies, records, communicates that information to necessary users. Now, who are those users? Well, we have internal users and we have external users. Our external users would be any shareholders, anybody looking to invest in our company. They could be people looking to lend money, bankers. We could have regulators keeping an eye on what we're doing. Then we can have also internal users. We want to keep an eye on what our profitability is, how many sales we're doing, all of those things. And the way that we would measure those things that might be more meaningful to us as managers might be very different than what bankers or shareholders want to see. So we break up how that information is reported. And what we're focused on this semester is the external user. When you move on to managerial accounting in later semesters, the focus of that class will be on the internal users. So accounting is a field that continues to grow in terms of opportunities. When people think of accountants, I think maybe they think of having their taxes done. And that's certainly a viable area of the accounting world to work in, but that is by far not the only area of accounting. You can do financial statement preparation, such as what we're going to be focused on in this semester. You could be an accountant that works internally, preparing the reports for the managers to be able to use in terms of decision making. You could do that traditional taxation role, or you could work in consulting, insurance, you could do investigations. I recently saw a job ad in the FBI. They were looking for accountants to investigate financial crimes. Kind of cool. I'm probably a little old to be doing that at this age, but you are not. The way that we used to keep books when I first started out, I got my very first job in an accounting firm not very long out of high school, in my first year or two of college. And everything was done manually. Tax returns were prepared by paper and pencil. We did get some software, and that was how I first learned to prepare tax returns. The partners were the individuals, collecting all the data and telling me what to put in, but it was my job to actually input this information. And those were some of the earliest programs that accountants were using. But the area of data analytics and artificial intelligence has moved that light years ahead. And now accountants are being asked to analyze really complex analytics. And I am currently working my way through the CPA exam, and this is part of what's being tested. And I have thought on more than one occasion how much easier this would have been if I had done this 50 years ago before all of this information existed, because I would still have the same license as the people who did this 50 years before me, and they didn't have to get tested on it. But oh well. So we're going to talk about the importance of GAAP, and there's an article in this week's reading on this. But what is GAAP? GAAP stands for Generally Accepted Accounting Principles. And what GAAP does is it provides us with a framework with consistent rules and reporting requirements so that you can take a set of financial statements from Apple computers and a set of financial statements from Microsoft, and you can compare those because we know that they were prepared in exactly the same way. And not only is it important that they are prepared consistently, but that they are prepared reliably so that those external users who are going to be making decisions based on those reports can trust that those reports were prepared in a way that they can be relied upon. Now, sometimes, regardless of how accurate we are in reporting information, there are instances where the financial statements may not accurately reflect the financial condition of the company because there are people that are committing fraud. And while we would hope that we would have strong internal controls and good audits that would detect those things, there are instances where through collusion, through thwarting of safeguards, that fraud is able to go on undetected for at least a period of time. Now, what causes someone to want to commit fraud? And what it really boils down to is three factors that have become known as the fraud triangle. And when you have all three of these factors present in a situation, the odds of theft occurring or misappropriation of assets is very, very high. So we work to try and ensure that those things that we can have control over, that we do what we can to lessen the chance that we have this perfect storm of the fraud triangle. And what is that triangle? It's the opportunity. And what do we mean by opportunity? Well, you go into a store and somebody's handling cash. They could put that cash in their pockets. But if the controls are really strong, maybe there's cameras overhead, maybe there's registers that are being counted periodically throughout the shift, all of those things would lead somebody to get caught pretty quickly. Now, I once worked at McDonald's back in high school, and every time the power would go out, all the electronic registers would go down, and they would bring out cash drawers. And we would have to figure out how to operate, and occasionally we would still have electricity, but for some reason the register system would go down and we would all be operating on cash drawers. Well, all of the safeguards that were in place on the electronic register system went completely out the window when we've just got, stacks of money in cash drawers and we're making change and processing orders. And I tend to be a pretty honest person, and it literally never occurred to me that I should behave any differently because I had a drawer of money than when the electronic register was being used. I discovered at some point that my coworkers did not share that same philosophy, and they would brag about how much money they were able to pocket every time those registers went down. So we clearly, in that scenario, had opportunity. Now, there must be, well, it doesn't have to be, but often you could have somebody who just does it because they can, but often a financial pressure. So what's going on with this person on the outside? Do they have unpaid bills? Do they have a lot of debt? Are they facing a medical situation? Do they, are there external financial pressures that, combined with that opportunity, could create a temptation? So you could have somebody with financial pressure and no opportunity, and you're going to be just fine because they have no access to funds. But that opportunity plus the pressure creates the opportunity for the third side of that triangle, which is the rationalization. And this is where they begin to justify. And I will tell you that in my law practice, I have represented more than one embezzler. And when they talk about the rationalization, it often has to do with having put in time that they felt like they weren't adequately compensated for, and that they had justified that what they were taking was really the compensation which they would have been entitled to had they properly been paid for the work that they'd done. Now, that may be where it starts, but then the slippery slope goes from there, because you know, most often they will test the water. If they get away with it, they will continue. And we'll spend a bit more time on this topic later on in the semester when we talk about internal controls. But this is something that really should be kind of an overarching theme through financial reporting, is the integrity of the reporting, not only from an accuracy standpoint, but to ensure that there is no fraud. So as I said, these financial statements are prepared based on generally accepted accounting principles. Now, who decides what those principles are? Well, it is this board called the Financial Accounting Standards Board, otherwise known as the FASB. And they promulgate these rules. There is also, for publicly traded companies, anybody that is publicly traded on one of the stock exchanges, is governed by rules from the Securities and Exchange Commission. They will largely, the rules are not inconsistent with GAAP, but the SEC sometimes has additional rules that publicly traded companies have to follow. And those are what are applied to U.S. companies, I guess I should say, because we also have international standards that are generally reasonably consistent, but then sometimes not. So as an accountant, you have to know both the U.S. GAAP standards as well as the international standards if you are working with companies with any sort of global reporting issues, which as we become more of a global society, that becomes a greater and greater issue. So in terms of establishing these standards, and I'm not going to spend a ton of time on this, I actually was, this was part of the first part of the CPA exam, which I took not that long ago, and it makes me twitch to even look at this slide. But the financial reporting standards have this sort of conceptual framework of objectives, qualitative characteristics, elements, and recognition and measurement. Additionally, they have what are called principles, assumptions, and constraints, and I'll spend a little more time on those. So they have general principles and specific principles. The measurement principle is assuming that things are based on actual cost and that that's an objective measure. We're not sort of guessing at our valuations. The matching principle, and we'll talk a whole bunch about this as we move into booking transactions, but the matching principle says that we want to match expenses that our business incurred in the same period as the revenue that was generated as a result of those expenses. So that, in a nutshell, is the matching principle. So expenses and revenue that were related are reported in the same period. The revenue recognition principle says that when do we recognize revenue? We recognize it when it's earned. Now, when do we earn it? We earn it when we have an entitlement to collect it. So we'll talk about cash and accrual basis, but if I sell something in a grocery store across the cash register, customer gives me cash, that's a pretty easy sale. But if I am in a much larger enterprise and a customer can be billed for those services, when did the sale get made? When the customer pays the bill, or when the sale that resulted in the bill actually occurs? And the answer is, it's when the sale happened. So we disconnect actual payment from when we recognize revenue. We recognize it whether or not we actually get paid. And sometimes we actually record revenue and then we don't actually see the money for it. And then we've got the full disclosure principle, and it's that we're going to make sure that financial statement users have all the information that they need in order to make knowledgeable decisions. We have 4 assumptions that we operate under. The first is a going concern assumption, and this basically says that we assume that any business that we are preparing financial statements for is going to continue to operate going forward, that this isn't just a company that's going to shut down the next day, because a company that we're going to liquidate is going to have a very different reporting structure than a company that we expect to operate on into the future. The time period assumption assumes that we can break down the financial reporting into discrete periods of time. Most often that time period is a year. The monetary unit assumption is that we're going to be able to express transactions in the form of, I would say dollars, but it isn't always dollars. We could be dealing with international currency, but in a monetary unit. And then the business entity assumption, which is that we have this business, but this business is owned by someone or many people, and the finances for the business are separate from the finances of the people who own the business. So we want to make very clear that we separate out and we don't intermingle personal finances with business finances. And this slide is thrown in here pretty randomly because we sort of take a step back to financial statement concepts in a second. But we have 3 basic types of business structures that we're going to be talking about this semester, although not all of them in depth. Most of them will be focused on the proprietorship, and to be a sole proprietor means that you can wake up one morning and you can proclaim to whoever is within earshot of you, I am in business. And that is literally all that it takes to form a business as a proprietor. It is just the individual, and there's no formal structure, there's no registration that has to occur with the state. They can just decide that they are in business and boom, they are. Now, we've got partnerships. It is basically what happens when now you have 2 people who get up and say, hey, we should be in business. You want to be in business? Sure. And they shake on it, and now we have a partnership. Also no formality, no registration required, and they come up with some sort of an agreement as to how profits are going to be split, who's going to do what, and quite often that's where things sort of fall apart. And then corporations. This is where these next 2 forms are where things start to become more formal and more complicated. We now have registration, we have separate structures, separate and apart from the individuals who own them, and I will let you read the rest of what's on the slide. So now we're going to hop back over to financial reporting concepts and talk about constraints. One of the constraints in financial reporting is the cost-benefit constraint. So we could count every piece of inventory every single day in a company to make sure that we have exactly the right amount of inventory every day. That would be horrendously expensive. Would it give us accurate and reliable numbers? Sure, but it would cost us a lot to do. So instead, maybe we only count our inventory physically once a year, and we hope that we keep a pretty tight rein on who has access to things like that, so that we don't have a substantial loss during the year. And you know that the risk of not having accurate numbers every single day is really balanced by the cost of doing that. And so doing that once a year would be one of those cost-benefit analysis things. The materiality constraint we only care about things that are material. There might be lots of little inaccuracies here and there that even altogether don't amount to a lot. People make mistakes. People are human. Even the best trained people might write something as a 6 when they should have written an 8, and as long as it's in pennies, that amount isn't going to be material. So we're not going to spend a lot of time focused on reporting inaccuracies that aren't material to the financial statement presentation. And lastly, we've got to focus on conservatism. And that means that basically we can often report things based on a range. And if we report at the higher range, our financial statement presentation might look particularly rosier than if we report at the lesser end of the range. And we want to keep in mind this principle that we want to be conservative in how we report. So we don't want to overinflate and give pie in the sky figures. We want to maintain some level of conservatism as we're preparing these documents, or I should say a high level of conservatism. And our last constraint is industry practices. Sometimes we have specific regulatory constraints that are placed on financial reporting that we are required to adhere to. And I have been rambling long enough, so I'm going to stop this video and hop on to the next one.